Hey guys, welcome back to my channel. If you haven't already done so, go ahead and drop a like, subscribe, and a comment of whatever it is that you want to see going forward in terms of content. So today I wanted to talk a little bit about some things that you can do to avoid paying taxes on stocks or just avoid paying some taxes overall in general based on your stocks. So a lot of people in 2020 have kind of just been really getting into the stock market game, buying and selling a lot of stocks. And let's say that you purchased your stock this year and sold it this year and you sold it at a loss, right? So typically speaking, you would already get a deduction of some sorts as long as it offsets your gains. So if you sold stocks and you had gains on some stocks and you had losses on other stocks, whatever losses you had are going to offset the gains that you made during this year. But let's say that you built a really great portfolio of stocks and you're coming into some gains and the gains are pretty decent, but you don't want to be taxed and taxed highly on those stocks. So what you could do is sell your stocks of a certain variety. So let's say you're invested in an ETF or some kind of SPAC or something along those lines, and you want to sell it, but you also to claim the loss and then buy it back later on. So typically speaking, it would be if you do this in a large quantity, this could trigger the IRS into assuming that it's a wash loss. So what a wash loss is selling a security and buying it back within 30 days in the same, and they have to be very similar stocks and in turn securities in the same kind of vicinity or area. So say I was buying Tesla or Google stocks and then I sold those and I'm buying back something that within the same industry around the same price range, that would be considered a wash loss by the IRS and it's disallowed, which means they won't allow you to use that loss to offset your taxes or offset your taxable income. So what you want to do is go ahead and sell that stock and buy it back in 31 days. It's as simple as that, if anything. So you'd buy it back in 31 days instead of 30 days. And typically speaking, you'd be able to claim the loss and at the same time you'd regain those stocks back into your portfolio. Now that the problem with doing so is that prices are very volatile within the market. If you're expecting them to be at an even lower cost after you sell them, then I wouldn't suggest doing that. But if you feel like the value might go up a bit or you're going to be able to buy them back around the same price range, I feel like this is a very valid strategy. Another thing about stocks as well is that whenever you have losses, you, depending on your filing status, have a certain limit of how much loss you can take per year for stocks. So as a single individual or a married filing separate or head of household, you have an allowance of $1,500. So say I sold a bunch of stocks and I had $2,000 of losses, I can only use 1,500 of that this year to offset my taxes, but I can carry forward the leftover 500 to the next year. So by doing so, you can kind of see that, okay, if I draw another loss next year, I can use that 500 from 2020, from the previous year, and also the loss from that coming year as well, and therefore. Now, what you would want to do with that too is that you can play around with it a bit. And let's assume that I make 50,000 this year. And I know next year I'm most likely going to be in a different tax bracket. So what I can do this year is pay off some taxes or offset some of my tax and pay some of that tax so that I could use more of my deductions or more of my losses and carry those over to next year when I expect that my tax rate or my tax bracket is going to go up. So that way I'm paying just a little bit of tax this year and just a little bit of tax next year as well, even though my tax bracket changed or something along those lines. So those are just some kind of two general things that you could really do just to prep. In terms of like a wash sale disallowance, that it's something the IRS might see or decide based on a case-by-case scenario. So it's up to the IRS to decide whether or not your sale of losses and then buying it back is considered a wash loss or not. So just to be safe, like I said, buy it 31 days or later afterwards, just so that you can try to avoid that. So a great way to offset or to avoid a wash sale loss disallowance or the IRS assessing your losses as a wash sale is by investing in an ETF with a diversified portfolio or like a diversified range of stocks as well, just so that it doesn't look like you're buying back the exact same security, if that makes any sense. So that's just kind of a strategy that you could do there um, to avoid paying some taxes. Let me know what your thoughts are in the comments down below, and if you want any more elaboration on this kind of topic, or if you want any specific uploads or videos, I'll leave that in the comments as well.